The most important thing you need to understand is you need to choose a car that's the most appropriate for your needs, and then you really just understand the tax consequences of purchasing that car rather than understanding the tax consequences of buying a car and then using that as a driver as to your decision as to which car you buy. First thing you need to understand is whether the vehicle you're buying is a car or not. So a car is defined as a vehicle where more than 50% of the carrying capacity is for transporting passengers. So a ute, by that definition, is not a car. And sometimes there's a little bit of confusion as to whether a ute would meet that criteria or not. So the ATO have issued an FBT exempt list of vehicles, which includes single cabs and dual cabs, just to make it a bit clearer so people know what they're buying. So the advantage with a ute is typically travel from home to work is considered private, but if you're driving a ute because you need to carry tools or bulky equipment, that trip from home to work is considered work-related. Now, also, even though the vehicle, the ute, is FBT exempt, and not a car, there is still FBT on the private use of a vehicle, but in many cases it'll be exempt because it's just very, very minor and infrequent and is often ignored. Now, if you're not buying a ute and you're buying a car, there is a depreciation cost-based limit, which in the 2018 tax year is $57,581. So you can buy a car that's more expensive than that, net of GST if you're registered, but the deductions for the car are just going to be limited to that amount. So you can buy a $65,000 car, you can buy a $100,000 car. The amount of depreciation that you're going to be able to claim as a tax deduction is limited to that amount. There's also a GST limit on the car as well that you can claim. So, and again, that is the car cost-based limit divided by 11. So you can buy a $110,000 car, or you can buy a $80,000 car. You're still limited to that amount of GST on the purchase price. Now, also, there's a thing known as the luxury car limit. So once you go above the cost of that car, the government adds a tax. Now that tax kicks in at $65,094 in 2018, $75,527 for a fuel-efficient car. So really, it just adds to the price of the car. You can't claim it, and it really makes no difference from your perspective. Like all things in tax, if there's some private use of the vehicle, there's going to be a tax consequence. So if the owner is a sole proprietor or partners, the private use of the vehicle will be apportioned based on a logbook. If no logbook is prepared, then pretty much all the vehicle expenditure will be excluded, and you'll just calculate it based on a cents per kilometre method, which at the moment is, in the 2018 year, 66 cents on the dollar. Now, if the private use is in relation to employees, and that's for all entities, the tax consequence is FBT, or fringe benefits tax. So for cars, there's two methods for working out the FBT payable or the FBT treatment. One is the statutory method and the other is the logbook method. So the statutory method involves just multiplying the value of the car by 20%. It's been simplified now. And then after 4 completed years of ownership of the car, then the value that the car is multiplied by is reduced by 1/3. So that's the simple method where you haven't prepared a logbook. The alternative method is you just prepare a logbook, and again, the private use as determined by the logbook is just multiplied by all the relevant car expenses, including a deemed depreciation and deemed interest rate. So generally you just compare the outcome given the two methods, and whichever is the lot produces the lowest FBT value, that's the one you choose. One final point is the FBT is often eliminated in businesses where the owner makes an employee contribution after tax. So no FBT is payable, just the income of the entity is increased and the GST liability as well. In summary, number one thing is obviously choose the most important vehicle, and then if that vehicle is a ute, just double check that it is a vehicle on the FBT exempt motor vehicle list. Now, if it is a car, then ideally you choose a car that was below the depreciation cost base limit, so you would actually get deductions for the entire amount of the depreciation across the life of the car. And if there is private use for a sole proprietor or a partner in a partnership, then just choose the best tax deduction method, which ideally would be the logbook method, but if not, the cents per kilometre method. If there is private use for an employee, then choose the best FBT method, either the statutory or the logbook method. And then finally, where there is some FBT, then try and use employee contributions to reduce that FBT to nil. All right, so I hope that helps, and thanks for listening.